The good news is that the stock market party may not be over. The bad news is that this might be the last lap before the final finish. Morgan Stanley predicts that stocks can mount one last rally this summer before hitting a peak during the second half of the year. Morgan Stanley cited a series of positives that are morphing into negatives. World economic growth is predicted to slow. Inflation is picking up. Washington has changed its focus from tax cuts to tariffs, and the Federal Reserve looks to speed up interest rate hikes. So let's take a look. Right now, both the rich and middle class are unsure where the market is headed next. Investor indecision is something that was easily detected in a fresh survey from Bank of America Merrill Lynch. About 41% of respondents think the stock market will get better, while only 32% believe it will get worse. Drilled down by income demographic and the general cluelessness on the market's next move is even more apparent. People earning greater than $125,000 a year were split on the market's direction and concentrated at the extremes. Roughly 24% of those surveyed think the market can get a lot better, while 22% expect it to be a lot worse. Middle income respondents on balance had a positive outlook as 44% anticipate the market to be better, while 30% think it will get worse. Excuse me for chuckling a bit, but we've been following the markets pretty close, and we've had a pretty good idea where the market is going. So hang around, because before this video is over, you will have Morgan Stanley's opinion of when the stock market will peak, and you will also have mine. I think it will be worth the wait. If one wanted to make a case to sell some stocks and raise cash, a look at the global economy would go a long way in helping. According to T.S. Lombard strategist Dario Perkins, there are scattered signs of global weakness. While macroeconomic data have proved more resilient at the global level, the outlook has also deteriorated compared to what investors expected at the start of the year. And Perkins has cited several areas of concern. First, Eurozone data has missed consensus forecasts by the widest margin since the global financial crisis. Perkins calls EU macro data in 2017 implausibly high, so a slowdown was inevitable. And the OECD is the Organization for Economic Cooperation and Development. It's a multi-country organization. The OECD's leading indicators have dipped. Global industrial orders and trade data have also softened, notably among Asian supply chains. And lastly, emerging markets more broadly have slowed, in part thanks to the stronger US dollar recently. With global growth slowing, investors could still be paying too much to own stocks. The S&P 500's price to earnings multiple is 6% above its long-term average, according to Bank of America Merrill Lynch, and values remain elevated versus history on most metrics. The biggest question on Wall Street is whether the bull market is finally running out of steam. Morgan Stanley argues the market is already in the midst of a topping process in which the market for corporate borrowing peaks first, followed by bond yields, and then stocks. Morgan Stanley says that corporate credit markets probably hit a top in late January, and history shows the stock markets tend to do the same 9 to 12 months later. Morgan Stanley says that points to a stock market peak in the third or fourth quarter. 2018 will see a series of rolling tops, and the extreme turbulence at the beginning of 2018 was not an aberration. It's not just Morgan Stanley adopting a more cautious attitude about stocks. About 60% of fund managers polled by Bank of America in early May said they believe stocks either peaked in January or will do so later this year. Investors are also growing more concerned that the economic expansion, which is already tied for the second longest on record, will falter before long. Sometime in the next year and a half, the economy will probably fade into a recession, says Guy Labas, who's the chief fixed income strategist at Janney Capital. It's part of the natural ebb and flow of the U.S. economy. Of course, this is not the first time that someone has predicted the demise of the economic recovery and the bull market, and those previous calls all turned out to be flat wrong. This cycle has proven to be extremely resilient, surviving the European debt crisis, the unprecedented downgrade of America's credit rating, and a crash in oil prices. And there are good reasons for stocks to keep rallying, including blockbuster corporate profits and Trump's corporate tax cuts. Interest rates are going up, but they remain at historically low levels. Timing the market is notoriously difficult, if not downright dangerous. Very few investors are able to jump in precisely at the right moment and then get out right before the storm comes. Morgan Stanley acknowledges that timing matters, and the actual sequence of market peaks may differ because no two cycles are exactly the same. Our forecasts are consistent with the usual late cycle pattern where topping is a process, not a point in time. And that process I've talked about many times. The good news is that Morgan Stanley doesn't anticipate a repeat of the carnage that the stock market suffered when the dot-com bubble burst or the great financial crisis struck, because those market crashes were caused by the biggest stock market and credit bubbles in modern history. And today's excesses aren't nearly as extreme. And again, that's according to Morgan Stanley, and I do not agree with them on that. I disagree with their point that today's excesses may actually be worse than they were previously. However, I do agree that the probability of a market peak later this year is a high probability. So, if you want to know when more accurately we're going to have a market peak, I suggest subscribing to this channel because we talk about the markets every week. And in my opinion, our subscribers know that after a recovery, that's when we expect some problems later this year. So if you want to know and you want to stay up with that market progress, then I suggest subscribing to this channel. But for today, that's ChewDog Charts. Thank you.